Rattle from Trade Monster in Chicago. I want to welcome you to another presentation, Trade Monster Education. Thanks very much for coming with us today. I have a couple disclaimers to run through. Please remember that options involve risk. They're not suitable for everybody, but investment involves risk, and the past performance in the security industry sector, market, or financial product does not guarantee future or results or returns. Please keep in mind that certain FINRA margin policies could limit or prohibit the execution of some of the methods we might discuss today. So to ensure that you're in compliance with those policies, please contact your brokerage firm if it's not Trade Monster, and if it is, please give us a call at 877-53190. Copy of the characteristics and risks of standardized options brochure from the Options Clearing Corporation by an email to info@trademonster.com. Solicitation for brokerage services, investment advisory services, or other products or services in any jurisdiction where we're not authorized to do business or where such an offer or solicitation would be contrary to the securities laws or local laws and regulations of that jurisdiction. We find fundamental data and market data from third parties that we think is reliable. However, Trade Monster makes no warranty as to the accuracy or completeness of the information. System response and access times could vary due to market conditions, system performance, and other factors. Trading always poses some unique risks to investors. The material being provided to us today is for educational purposes only. Certain content will be presented by our third-party educator who is not affiliated with the Trade Monster Group. The information contained in this material has not been endorsed or approved by the Trade Monster Group. Trade Monster and the Trade Monster Group are not responsible for the content. No information presented constitutes a recommendation by Trade Monster or the affiliates to buy, sell, or hold a security, financial product, or instrument. Not be construed as an offer or a solicitation to buy, sell, or hold any securities by Trade Monster or our affiliates. Please, investment decisions should be solely on an evaluation of your own financial circumstances, investment objectives, risk tolerance, and liquidity needs. Please remember also that neither Trade Monster nor any of our affiliates are affiliated with the third party who provided the content. And while waiting, you might have noticed our social media addresses. Please follow us and like us on Facebook and Twitter. Read our Bytes daily blog for trading news, insights, and tips, and visit our YouTube channel to view videos about the platform tools. As mentioned, our presenter today is the CEO of OptionsMoneymaker.com, education provider who provides world-class education for traders. And today we're going to talk about the art of trading as Mark Dannenberg brings wisdom on the use of credit spreads for all markets. Mark, take it away.
I appreciate everybody who's taking an hour of their time to listen in as we discuss the art of trading. Just to talk a little bit about my background. Mark Dannenberg, and I have trading for over 25 years. Futures, commodities, stocks, and options. I've traded options exclusively for the past 10 years plus. I am a day-to-day teacher, trading coach, and trader. I've taught hundreds of traders since I started teaching in 2006, and I work one-on-one with clients. I work through group clubs with clients. But more importantly, I'm also a trader. So I'm active in the markets every day. What I teach is based on what we experience in our own trading. It's based on real-time experiences. It's based on hypothetical, all back-tested information. It's based on real trades. And we, Options Moneymaker, focus a considerable amount of time on strategy design, taking core, commonly understood strategies and refining them with very specific sets of rules so that we can create consistent level of profits and have fun while we're trading. We do enjoy our trading. We enjoy having fun while we do it. So we like to as anxiety and fear-free as possible. To do that is to have some level of design that allows us to have a consistent level of return. Prior to trading, while I was first learning to trade, I spent 26 years as a senior vice president with 500 companies, running business for them, and enjoyed trading as a hobby. My career and decided to focus on trading full time. I decided that I would help other traders learn how to perhaps cut short that 25-year learning curve and learn to trade profitably more effectively. Today's message really is all levels of options traders. This strategy is accessible by any trader, regardless of your level of experience. Now, if you know anything about options at all, it does require you to spend a little bit of time. There's lots of great free content, free information on the Trade Monster web under education. It requires you to have a basic knowledge of the characteristics of options. Familiar with things like the value of an option. You should be familiar with theta and time value decay of options. But if you're familiar with the basic characteristics of options, what about today, which is calendar spreads, is something that really is a strategy that's applied by anybody. If you're familiar with debit spreads in particular, this will be very easy for you to understand. Debit and credit spreads are two very basic spread strategies that are available to options traders. So I hope that you're interested in learning how to achieve profits and will to break old unsuccessful patterns. Take a minute and talk about this because I think it's key to the success of a trader. What causes trading anxiety? Well, there are a few basic things I've learned from my own experience, as well as the hundreds of traders that I've worked with over the last several years. Capital commitment is probably number one thing that causes anxiety with trading. You either have too much risk on, too many contracts, or too many positions. You lack of what's going on. You're not comfortable. You're getting behind. You start to worry, you start to panic, and you start to make bad decisions. Keep capital commitment down to a reasonable level, an amount that you're willing to lose. And I'm not for designing our strategies for losses, but if it's not that you're willing to lose and it's not going to affect your lifestyle, it's not going to affect your trading account significantly, then you're going to reduce your level of anxiety. Also, no understanding of how to properly manage or adjust positions. Then you're dead in the water when the stock or the index moves against you. You know how to take action, what to do about it. You're dim the lights, and you are just paralyzed. And again, you take inappropriate action. It is going to cause you a lot of anxiety because you're internally in your body trying to sum up this energy to push the market, push a stock one direction or another. You want to move now. You need it to move now. You're tired of waiting. It's going to cause stress and anxiety for you. What really should be trading with is an attitude of wanting what the market wants rather than wanting what you want. Okay, we want what the market wants. We want to trade consistent with what the market is offering us. We look at the market gifts to us every day. We should be grateful for the gifts that it gives us. Sometimes we want to return that gift, get our money back, but that's what it's all about. The media will also sometimes create some stress and anxiety for you because there are certain focused news stories or focused interviews that are you thinking contrary to what you originally believed. And you can hang your hat or your trade on any one interview, one piece of information from our financial media. Trust what you trust what you've learned, and stick to your trades. And then speculation rather than management. Speculation is really in the category of I'm willing to move in my direction rather than managing it effectively and taking action when I need to. I really want it to move. I'm hoping it's going to move. I'm praying it's going to move. And that's just pure speculation, and that's not going to help you out other than create a certain level of stress and anxiety. So I like to just talk about this for a minute, because if you can eliminate the stress, eliminate the anxiety from your trading, you'll enjoy it a lot more. You learn a lot more because you can learn even from the trades that didn't work out. And in the long run, you'll end up being a more successful trader. Strategy is really to simplify in order to multiply. We're going to try to fire strategies, and we want to try to multiply our dollars, compound our profits as much as reasonably possible. When you're starting out, it's very tempting to dive in and start taking on as many trades as you can. It's very tempting also to maybe focus on a single trade and low wagon and put on too many contracts. It's also very tempting, especially if you are a fan of attending seminars and attending webinars and about new strategies. It's also tempting to adopt multiple different strategies, and all that combined is going to confuse you, and it's going to limit the degree of success that you achieve. So what we like to guide our clients to is to use a coach or a service, so have some sort of subject matter expert. Limit, especially when you're first trading, the number of different strategies you use to a very few, and I mean maybe just one or two, and get really competent at those 1-2 strategies. Two strategies is going to create confusion, and then it just starts to muddy your thinking, and you're not sure what to do anymore. Take a single strategy, for example, and single strategy over and over again. Trade it repeatedly, even if trade it virtually, to learn everything you possibly can about that strategy, to become constantly competent of that strategy and how it performs. Virtually is an outstanding way for you to become familiar with the dynamics of a strategy. If you attend a seminar, you attend a webinar, and I appreciate the fact that you're attending a webinar here today, but don't take verbatim what anybody in a seminar or a webinar or may read in a book tell you to do. I strongly advise that you listen with an open mind, adopt strategy, go trade it virtually for a while, and become so familiar with it until you're confident that it works in the way it was described. That would be the best way for you to go through an education program on how to trade. All of this is intended to program yourself to be confident. Program yourself so that you understand the dynamics of trade, the dynamics of a spread, what happens when the spread is behind, how quickly your spread can actually gain. There's also analysis tools that are available. And Monster's website, their platform has some outstanding tools available to you, but the best available to you is experience. And the best way for you to trade and gain experience without gaining anything is virtually. At least you start out. This is all about the mission of the process, programming your understanding, validating it, and creating a conscious competence of winning. At Options Moneymaker, our philosophy for winning is following. We prefer to trade strategies that have profit opportunity regardless of direction. Now, not strategy is going to allow that to happen, but there are strategies, and there's one I'm going to profile today, this category, that even if we decide that the market or a stock is going to decline and it goes up instead, there's an opportunity to make money on it. There's a forgiveness factor. So we trade strategies like that. We leverage the basic characteristics of options. Delta and time value, delta and theta, which is the time decay, are two of the most basics that we take advantage of and work to our advantage. simple, repetitive approach in order to optimize understanding, which ultimately is going to lead to confidence and success. What that basically means is we do the same things over and over and over again. You don't want to do something 2 or 3 times and say, well, that worked really well. Now let me go find something else that will also work really well. And in looking for those other 2 or 3 things that I think might work well, I still lose sight of what already worked well for me in the first place. When you're on a roll and you feel very confident with a strategy, concentrate it and be very careful not to dramatically increase your position size just because you think you got it all dialed in. Small position size frequently and compound the profits into each new. Okay, increase gradually, but you're doing it based on profits that you're accumulating. And we want to set aside fear. We want to have fun every day in the market. All right, what I want to share with you today is the calendar spread. The idea of the calendar spread is one that I propose as just a single idea for successful trading. I'm saying that this is the only way you should trade, or this is the single strategy that you should start out with. What I'm proposing here is the concept of selecting a single strategy for trading, and that the calendar spread could perhaps be that strategy. And I'm going to walk through the calendar spread strategy with you and show you why it may be something that you want to pay attention to. It's a strategy that works for all levels of traders. Okay? Now, the next 3 bullets are about our experience at Options Moneymaker. It has hold time to it. Our hold time on these is about 5 days. So we get in, we get out. It has excellent returns. The average return per trade is about 12%. Now, those returns, now don't confuse that with a 12.5% return every 5 days on your entire portfolio. Remember, trading small positions that accumulate to a really nice return on your portfolio, but each small position averages about 12.5%. Loss ratio 2014 to date on our calendar spreads is 93% wins. So we have a high win rate, we have a very solid return rate, and we're in and out in an average of 5 days. Now, as you see, we have a 93% win rate, so that means we have some losses. We ought to limit our losses, and I'm going to show you how we do it just by the structure of the trade. We use 15 minutes per day to review our position, and it is important if you're going to be a trader that has time every single day doing an evaluation, an analysis of your position. What does it look like? What are the indicators telling me in terms of a directional bias of the stock or index? What action need to take today? If I computer off, I can move on and back and reevaluate the position the next day. Adjustments when necessary, but the important ingredient here is we must evaluate the position every day. Trade the indexes. That's one suggestion that we have. The familiar you become with a particular stock, a particular equity index, the more comfortable you with your trading. Take a single strategy, such as the calendar spread. Take a single index, such as NDX, NASDAQ 100. There's a lot of new research you have to do every day. It becomes almost second nature to you to figure out what the actions are that you're going to need to take. And you now develop this competence into being able to trade successfully. Charts and maintenance, okay? That art of trading relative to the calendar spread. I'm going to get into the specifics and the details of the calendar spread here in just a minute. Strategy is designed to leverage the cycles of an equity. I'm a believer, because I'm a technical artist, to go up and stocks go down. You hear people talk about that stock just won't quit, it keeps going higher. In the big picture, yes. A narrower view, when you look intraday movements, you see that there are cycles up and there are cycles down. That's what we want to leverage. We also take advantage of decaying time value of options. We want to be the sellers of options, allowing us to take advantage of the decaying value of those options, which help us achieve profits. We like the calendar spread also because it tends to be a short-term profit trade. Now, our definition of high profit is, percent is a pretty good return, we think, on a trade. Short term is 5 days. Now, if you're a day trader looking for intraday profits, you're swinging for the fences looking for 100% returns in a matter of half a day, that's the same as what I'm proposing here. Proposing a very simplistic way to trade that I believe gives you a reasonable profit and occur in a reasonable time frame. So, have opportunity to win when the index moves against your position. I'm going to show you an example of that in today's presentation. All the calendar spread requires minimal adjustments in order for you to be successful. I think that the NASDAQ 100 index is excellent for calendar spreads. Now, used by the Qs. I'm not talking about the Qs. I'm talking about the symbol NDX. NDX. That's the NASDAQ 100 index. The Qs are ETF that follows NASDAQ 100 performance. The NASDAQ 100 has a wide range of movement between support and resistance. I'll just tell you, since June 6th, the NASDAQ 100 has gotten into a much narrower, a more narrow trading range. Probably more narrow than I've seen in a long time. Volatility is extremely low. Range of movement has decreased, but even in that decreased range of movement, the move between support and resistance since June 6th has been just over 50 points. So there's a 50-point range of movement, not on a daily basis. I'm just saying when it hits lows and then back up to the highs, that range of movement for the last 3.5 weeks has been somewhere around 54 points. The times from those highs to lows and back again is relatively short. That 100 moves up and down. It cycles up and down. If you take a giant step back and look at the picture, you are going to see that there is a long-term rising pattern. There's multiple time periods that are showing long-term rising patterns on the index. But on the intraday movements, the sometimes are relatively short. That's important is it gives you an opportunity to get in, out, and that's why we're able to do an average of about 5 days in and out of these trades. Any premiums, exit premiums to sell to open, bring into your account significant time value, but there are great premiums to work with on NDX, and I'm going to show you an example of a trade here in a moment. Properly constructed, an enter spread basically allows you to wait for a profit exit. Not all of them are going to be profitable. As if they were, we'd have a 100% success rate. But we don't have a 100% success rate. We have a 93% success rate. Let's set up a calendar spread on NDX. I want to walk you through the specific steps to do this and how to select the expirations and select strikes and how that will play out. Now, our objectives are to leverage time value, follow the cycles of the index. Okay, allow for slippage value of the long leg, which I'll explain in just a few minutes. Chart position is important for calendar spreads. Chart position is very important for calendar spreads. So it helps if you are fairly comfortable with reading the chart. Your technical interpretation of is in bias up or bias down. Spread on a chart for the directional bias. And to select out of the strikes. We're going to select out of the strikes that are generally 10 to 25 points out of the money. Select expirations according to the following rules. We're going to open 1 week out from today, and buy to open 3 6 weeks out from today. Now, how you combine those expirations gets a little bit more involved, but very simply, if sell 1 week out from today, I'm more than likely going to buy 3 weeks out. Sell 2 weeks out from today, I'm probably going to buy 4 to 5 weeks out. The rule here is, and you'll become more familiar with it the more you trade, the simple rule is the further out I sell, the more distance I want to leave between the short leg that I'm selling and the long leg that I'm buying. If selling the near week, if I'm just 1 week out, comfortable going just 3 weeks out and leaving 1 week between my short and my long. If I, for example, wanted to sell to open 4 weeks out, this right here is what we more frequently do. If I will sell 4 weeks out, well, I'm probably going to try to leave 4 to 6 weeks between my short and my long. Just a rule that we follow based on the dynamics of the time value of options and how we want to leverage that. To the expirations. Selected the strikes. We're going to buy to open and sell to open the same strike. So same strike, different expirations. And that build our calendar spread. So if we will set up a calendar on NDX, and NDX was trading at 3,800, which is about where it was trading today. It didn't move a lot today in terms of absolute close from close to today's close, but move up and down in about I think it was a 15, 18 point range today. So we're going to assume that we want to put on a calendar spread and trading around 3,800. Our chart read tells us that there is a short-term bias down. That NDX has more of a bias to move lower than to move higher. What we're going to do, try to open the July monthly expiration, 30C put, and that costs us about $36.40. Simultaneously, we're going to sell to open the July week 1 expiration, 30.80 put, and that was a credit of $19.65. Now, TradeMaster makes this all very easy for you. You can set up this spread, you buy and sell all in one transaction, and you're going to basically open this spread for a limit debit of $16.75. Ultimately, we pay $36.40 for the long, but we've in credit $19.65 for the short, so we end up paying $16.75 for position. The cost of the trade is $75. You on the put is $19.65. We like to construct our calendar spreads where the we receive on the short is greater than the total debit for the position. And the reason we like that is because that $19.65 is the money. Remember, we bought and sold the 37.80 strike. The 30 points out of the money. It means the value we sold on the leg was value. There is no intrinsic value in that option. It also means that between now and expiration of short, all that value will decay away. That's in just 9 trading days. 9 trading days, which means there's going to be very rapid time back. If we want to sell premium, then the total debit of the position is, it gives a lot of cushion. It gives us a lot of room to get paid profit. If I wanted to exit this trade, if my objective was to exit the trade for a 20% return, I would need to take about $2.35 of profit out of the trade. Is we would base that in order to close this for $20.10. Paid $16.75. If I sell the spread for $2.10, I would lock in a $3.35 profit. Will be a 20% return, $16.75 that I paid to open. 20% is great. Now you see from our performance that we average about 12.5%. Okay, so we don't achieve 20% on every trade. But what I'm showing you here is that $3.35 would be a 20% return. The next 9 trading days, that $18.65 is going to decay away. That to me is $18.65 decay away. I don't wait for decay away. Some few days, and you know that our trading experience is we have these trades for an average of 5 days. Next few days, they're likely time value decay out of this trade for a 20% return. Now, as Moneymaker, our targeted profit range is 10 to 20%. Anything we're in a 10 to 20% profit range, we're likely to pull the trigger, trade, and look for the next opportunity. These calendar spreads is you can win all the time. You think there's a to class? Open, put calendar spread just like we've laid out here. When you have profit, and you see that the directional bias has shifted, you put a fall calendar, and you can ride it back higher. It does to move in successful, and that's key of the calendar spread. It doesn't need to actually move in order for you to win. What we're leveraging here is the decaying time value of the option. So, another fear about this is we think this is going down, but position could possibly be profitable if wrong. Profit of a calendar spread position is going to be mostly by the decaying time value of the shorts. Remember, we've got 1965 to decay away. If by some miracle we held on to this position up until expiration, and we can all of that time value at profit and had 1965 of profit, if our long leg retained 100% of its value, no profit, no loss, I have better than 100% return on this. We're not thinking for the fences on these, folks. We're not trying to earn 100% returns on these. There are calendar spreads that just by the nature of the trade, by the moods and cycles of the index, you can earn 30, 40, 50% naturally. We don't get it, and like I said, if we're in a 10 to 20% return, we'll go ahead and grab our profit, and we're going to start over with a new chip. So if you write on the direction, the position, both movement and time value decay. Remember, we owe this position by placing our strikes 20 points out of the money. Indexing at 3,800, we at 780. Index moved lower to 790. All of time value decay working for us on the because it still is 10 points out of the money. Also would have gained on leg. We would have lagged because we moved from 3,000 to 3,780. Point move. Basically, delta value of the long legs on these are going to be more around 0.4. So a 10 move is going to gain roughly $4 of value. Leg. So in the long leg, and you have gained time value on the short leg. If it doesn't move at all, it just lingers around 3,800, which the X seems to have been doing for the past week or so. But if it just lingers around 3,800, and profit on the long leg, which you don't need, you have a small loss on the leg and win because 1965 of time value that continues to decay away every single day. Spreads basically buy you time, and you're right on the direction, but maybe you're premature on the entry. Maybe you're right on chart read that the index is poised to go down, but perhaps it lingers at that price level for a period of time. This is a trading strategy, a spread strategy that does not require the index actually move. You win if looks around 3,800. You win if it moves lower and you are right. And you possibly also can win if it moves against you. Spreads are forgiving. They're more forgiving than most any other spread strategy. And the reason is because K is working for you as the price of the stock is moving against your position. What I want to address here before we get to the move against you. If the index moves rapidly, let's say we're right on the direction, and it drops suddenly, cause short leg to be in the money. It doesn't because the long leg is gaining in value. The short leg is still giving up time value. Your short leg may now be incurring intrinsic value, adding intrinsic value, but being offset to some degree by the time value. You've got multiple factors going on that are helping you, even if there's an abrupt drop in the price of the index. There's an abrupt drop. You've got on delta increasing the long value. You've got a net working against you, which is intrinsic value on your chart. Simultaneously, you have the time value. So let's just think about, I'm going to go back here for just a second because I don't want to miss this point. Our short that gave premium from 1965. And simplicity in math here, we're going to say that's $20. Okay? But is the NASDAQ can actually move down to 3760. 20 below our strike and would make even. If you got to expiration, the index was trading at 3760. You for $20 because it is $20 in the money, but you are a little less than $20 of time that has decayed away. So the value of the option is that you didn't make money and you didn't lose money on the short, even though it is 20 points in the money. While the index has moved down to that level, it's actually made a 40-point move. The long leg has gained value at the rate of delta. So it's a 40-point move down, and the 4, the $16 in value, dollars of profit. Afraid of index short leg being in the money, especially if there's still enough time value in the position to turn overall position into a profit. Trading indexes like this is, since they're European style indexes, you don't have to worry about early assignments. You don't have to worry about being assigned when you're in the money. You can ride it right up to expiration. Next, were instead to go again. You might have been wrong. You might be mature on your read of the decline, or you might have just been plain wrong. That has to. What if NDX were to go up 40 points instead of hovering at its current price level or go down? This should actually still be profitable. So how do you calculate that forgiveness factor? And the more familiar you become with trades, the more second nature it will be for you when you're evaluating a trade. If you moved up 40 points, the short at expiration is going to expire. It's going to end up being 60 points out of the money because it's 20 points out of the money when we opened it, and now the index has moved 40 points higher. So we actually take a profit of 1965, which is a short leg expire, and we took that 1965 as a profit. Long leg is going to lose value at the rate of delta, and it was $16.80. The way we calculated that is it's a point move, and then based on when we opened it, this is how I'm doing the evaluation. 4.2. That means that for every one movement, then it's likely going to change in value by approximately 40. See, 4-point movement times 0.42 means it's going to change in value by 1680. And since it was a move against us, it would incur a loss of 1680 on that long put. The 1965 profit from short leg, I can afford to take a $16.80 loss on the long leg and end up with a $2.85 profit overall, which is 17% return. So obviously, doing this in a pure environment here, it would never be exactly that in a real environment. I might experience some slippage on the long, meaning I might have some time value decay on the long that's working against me. But remember, I said that our profit target range at Options Moneymaker is between 10 to 20%. And this pure academic calculation tells me I could still make 17%, even though the index moved against me 40 points. I give you somewhere prior to getting to expiration, I'd be out of this trade for maybe somewhere around 10%, maybe 5%, maybe 3%. May be willing to exit out at break even because I see that it's moving significantly against me. What I'm driving to you here, though, is a trading strategy and a spread strategy that has forgiveness to it. You don't always have to be right on the direction. You can be wrong on the direction and still come out okay. The outcomes in trade. One, I closed for a profit. That's great. This is I click break even. Still considered to be that to be great because you didn't lose any capital. You might have given up some time and some profit opportunity, but that's still a win. You're back to play again. Third outcome is I closed for a loss. Well, it's just going to happen sometimes. The more wins and break evens you have, the less of an impact the loss is going to have over a long period of time. Spreads can be very forgiving. Now, there's that we teach at Options Moneymaker, and I'm not going to get into it deeply here today, but it's called a market tamer position. And very simply, a market tamer consists of two back-to-back calendar spreads. The non-standard version of a market tamer is a call calendar spread and a put calendar spread simultaneously. The reason I like this is because what essentially you're doing is you're learning to adopt a calendar spread strategy. And if you decided to focus on that, let's say for the next 6 months, and you wanted to trade was a calendar spread, you find yourself looking at the chart and you're not sure which direction this thing is going. And then you do that, well, I don't really need to know the direction specifically if there's no clear direction. I can still open a calendar spread, but I can open both a call and a put simultaneously. There's a certain amount of forgiveness built into the calendar spread. So I know one of these is going to win and the other one may be challenged by a move of the index. But as long as that challenge of the index allows smaller profit or break even on that side, overall still in the game, overall I still win. And I'm still focused on a single strategy that I'm becoming consciously competent to trade. Strategy, cash spread strategy applies in trading markets, and it has flexibility to also adjust and be a non-directional strategy. And that's the reasons that we really the calendar spread strategy, we trade it the way we do. I want to take questions here, and before we just want to tell you about a service where you can follow along with these types of trades. Options Moneymaker, we offer what's called our Platinum Trade Alert service. And what it includes is a daily email alert with specific steps for each trade. Now, we're not alerting just calendar spreads. We're not alerting just market tamers. They're part of what we alert. But we trade credit spreads. We trade long vehicle spreads. We trade diagonal spreads. We trade a variety of things. We alert all those when we see an opportunity, and we are opening trades in the accounts that we manage. This also allows you to dial in to a webinar and listen to a conversation, basically. It's a real-time working conversation that I'm having with my trading team. So my Scott and Allison, we are evaluating every open position that we have. This is our commitment of time to our positions. We do a chart evaluation and we do a position evaluation to determine whether or not there's any action that needs to be taken. And if there is action, we ask what action would be most appropriate. So we do these conversations. We have these calls every single day anyway. And what we do is we invite our subscribers to listen in on the call. It's not a question and answer session. It's not designed for us to answer all of your questions. It's for you to listen in and learn in real-time market conditions exactly why we are making the choices we are, choices that they are, and you can follow along with us. The Trade Alert service also includes a weekly 60-minute position management webinar. Now, that's a webinar that I teach once a week, where I talk about the finer tuning aspects of trading, where we talk about doing a deeper dive on specific strategies and to refine your understanding of specific strategies, specific management techniques. All of those weekly webinars are recorded and archived, and you can go back and listen to them as frequently as you want to subscribe to the service. We want to guide people along on how to have fun and how to grow your account. That service offered at $5.99 per month on a basis. But for the Trade Monster folks who are listening in today, if you have an interest in signing up or exploring our service, we're offering a 2-week free promo. That's not a 2-week free prom. Okay, that's a be promo. So I'm not going to send all of you to the prom. You don't need to go buy courses. But if you're interested in sampling our service, you can copy your screen and you can sign up for a 2-week free trial. During that 2 weeks, you're going to participate in 10 trading days of daily calls and 2 free webinars, 1 each week. And you'll get to participate in any and all of our daily trade alerts. So you become familiar with the service, not asking you to commit anything front, but if you like the service and you want to continue, then it will just automatically roll over into a monthly rate. So that's what we offer. I'm going to leave that up on the screen so you can copy down that URL. The link is http www.optionsmoneymaker.com/2-week free platinum, hyphen between each of those. Let me focus on some questions here. Go back to the beginning of the questions here. Question from David: would you do this trade in a high volatility environment? Well, David, our rule simply is when volatility is high, we prefer to the sellers of premium, and when volatility is low, as it is right now, extremely low, we prefer to be the buyers of premium. So a lot of calendar spreads right now because of volatility environment. However, on the NDX, the calendar does very well in a higher volatility environment. And the reason is because you can place your strikes further out of the money, get a bigger premium. It was just a month ago that if we had set up this trade being 20 points out of the money, we've gotten $30 to $35 in premium on the short. And yes, the long is costing more also, but the dynamics between two was about the same. So I'm still spending, roughly $17 to buy the spread, but being 2x, 2 times that in premium short, like the high volatility environments also. So it works very well in both. But to qualify that by saying, as a general rule, prefer to be the seller of premium in high volatility environments, which would be credit and those strategies. Grabbing another question. What do you decide when to adjust or get out? Simply monitoring our charts and looking for clues based on our support and resistance. We're looking for clues on our Bollinger Bands and our other technical indicators. So if the index has moved significantly lower and it looks like it's continuing to move lower, we want to stop too much in value being added to our short. And if we see it's going to continue moving lower and we have a profit in the position, we'll probably go ahead and take off position. But let's just say the index moved right down to 37.80 2 days after we opened this trade. And we have 7% profit in the trade. Us like it's going to bounce from here and it's going to move higher. Still have $17 time value in that short. Probably going to hold that position for another day and evaluate it again the following day and decide whether or not I want to exit out, take my 7% profit, or where a bounce back higher is going to increase the rate time value decay on my short and actually get me somewhere in my desired spot of profits, which is 10 to 20%. So it's the things that we're evaluating. We're very simply looking at the chart, and we're evaluating the remaining time value in addition. To focus on out-of-the-money calendars only, or do you trade at-the-money calendar spreads? These sorts of variations to this type of strategy, John, and trade them all. What I'm presenting to you here today is a simple, probably more conservative approach to the calendar spread, but there are some variations, and yes, you can do calendars at the long is going to gain intrinsic value immediately on a move, but the short is also going to start to gain intrinsic value immediately. And as long as you're comfortable that there's enough time value to offset the to offset the intrinsic value gain on the short, then you can do that. But I would strongly suggest, if you haven't traded this strategy before, that you start with out of the money, get really comfortable with it, and then you can always create variations. Market tamer, which I mentioned, which is just back-to-back calendars, a call calendar and a put calendar. The non-standard version of that is maybe go 20 points out of the money on either side. So if we had created a 37.80 put calendar and we wanted to turn that into a market tamer, we would have created a 38.20 call calendar. But we also have taught in the past through our education courses tamer where all four legs are at the money, and that has some very profitable, potentially profitable dynamics to it because of the way index cycles up and down. And so it can be a huge win if you are a very attentive trader and you don't just put this on and come back and check on it a week later. That's not going to win for you. Gamma increases as index goes up, causing delta to rise. Well, all the what-if scenarios that you have to get comfortable with, trade strategy, and trade it virtually if necessary to really familiarize yourself with it. What I presented to you is a real basic understanding of the strategy and how it works. But as we all know as traders, when you start trading in a real-world environment, there are other factors that can influence it. What I do know is that on a year-to-date basis, of all the calendar spreads we've traded, we have a 92% win rate. That takes into account all of the different things that we've had to deal with. Yes, delta might rise, but delta rises on the long, might lose more on the long, right? We're getting close to expiration on the short. It really becomes a matter of how much intrinsic versus extrinsic value it has, and it's not as dependent on the delta value. You depend on the delta value on the long more because the long is further out, 2 weeks further out. What time? Okay, thank you. Calls are daily. And I'm on the West Coast, so I'll quote Pacific time. We have to do 2 calls. If you're a platinum subscriber, you're able to participate in 2 calls. We have what we call a 5K challenge going on right now, which is just, how big can we grow a $5,000 account, single position every week. But that becomes part of your subscription to the Platinum Trade Alert. So we do a daily call for the 5K at 30 Pacific. We do our daily call on the Platinum Trades at 10 a.m. Pacific. Comment about the earlier question. I don't want to gloss over it. The question about if gamma increases and the index goes up and increases what's hurt you worse than the example. Absolutely. That end up being a situation where that's one of your losses. And you can, I think, though, that even if we were to lose, there's a certain amount of forgiveness in the index. So even if gamma rises, even if delta increases, there's a certain amount of forgiveness. If a point move up with everything being pretty equal to what it is now, we still make a profit. Well, what if that was a 50-point move up, and to your example, the delta increase causing us to have more of a drag on the long? Well, that may end up being a loss to us. But net of the fact that you've got $19.65 of profit to work, and you end up losing no matter on your long, then you're break even. If you ended up losing $2 more than that on your long, well, that ends up being one of the losses. But we don't encounter that as we don't encounter that very often. Question and then call it a day. Would you wait till close to expiration time to close this? So that max gain would be close to expiration short. That is correct, Rick. We don't necessarily wait till close to expiration. We actually try to stay away from holding until expiration. You see that if we held right to expiration, the 1965 was to have way better than a 100% return. We're targeting a 10 to 20% return. And the main reason, this is my comment, main reason that we don't hold right to expiration is because a sudden move before expiration, that sudden move could cause our leg to be significantly in money, creating a significant amount of intrinsic value, and it'd be much greater than we have set with time value on the long. So we just stay away from expiration. We'd rather take our profit in the 10 to 20% range and just open a new position and put expirations out another week. Everybody being here, thank you so much. Again, if you're interested, you can visit our website, optionsmoneymaker.com. You can email me if you have other questions, markd@optionsmoneymaker.com, or you could sign up directly for a 2-week free trial at the link that is on your screen. So I appreciate it.
You'll be hearing from me in the next day or two about next month's topic and time. We'll try to open up a spot for you in a good, convenient time. I will thank everybody. It's been a big crowd today, and you benefited from Dannenberg's wisdom. If his service can be of any use to you, please advantage of him. Don't take advantage of Mark. Take advantage of the offer. And utilize the services. Everybody needs more trading education. We know that's why you come to Tracer Education for some new strategies and to hear from other speakers. We're going to continue the series. And we've got a big week of webinars tomorrow. Dr. Given, or Dr. Duke as he's known in the industry, will be with us for a webinar. I'll do a mentor session during the day, and Matt Buckley will be here from Top Gun Options in the afternoon. Ladies and gentlemen, thanks very much. We know you want to be a better trader, and we try to provide you with ways to become a better trader. So thanks very much.